Welcome to Wealth and Means, advice dressed up like hard work.
This week, we're looking at a paradox that's defining April 2026. While consumer confidence is collapsing, while oil's back to 2008 crisis levels, while jobs are disappearing from tech and logistics, capital is flooding into AI infrastructure at a pace we've never seen before. We're talking $300 billion in a single quarter. That's not optimism. That's not even conviction. That's the sound of money running away from the present and sprinting toward the future. In this episode, we're tracking the signals nobody's talking about, prepping you for the macro weather ahead, and asking a question that hasn't been asked loudly enough. If everyone's building the next world, who's going to pay for it? It's a week where the numbers pull you in two directions at once. Each week, we explore ideas that help you pause, reflect, and think more deeply about the opportunities all around you.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. First, let's begin with what you didn't see in the news. Let's start with a story that ran in a science journal called Light, Science and Applications 2 weeks ago and got almost no general press. And it might be one of the more important energy storage announcements in a decade. Scientists at CSIRO, RMIT University, and the University of Melbourne demonstrated the world's first working quantum battery prototype. The device is small, a layered organic chip, and it does something that is genuinely counterintuitive. It charges faster as it gets larger. Every conventional battery you've ever owned works the opposite way. This one retains stored energy for 6 orders of magnitude longer than it took to charge, and it charges wirelessly using a laser. The team published on March 18th. The story circulated briefly in science channels and then disappeared.
Charges faster as it gets bigger is the kind of sentence that rearranges industries if it scales. We're pouring hundreds of billions into AI infrastructure and debating power generation. Nobody's asking whether the bottleneck is actually storage and whether we've been building the wrong solution.
That same constraint obsession connects to a paper out of UC Berkeley that ran on March 28th and generated almost no mainstream coverage. Chemist Omar Yaghi and his team published results on a material called COF1000, a covalent organic framework that captures carbon dioxide from ambient air 3 times faster than its predecessor. The key fact is the release temperature. COF1000 drops its captured CO2 at 60 degrees Celsius, which is low enough to run off factory waste heat or basic solar thermal. That puts direct air capture on a credible path to sub $100 per ton. $100 per ton has been called the holy grail of carbon removal for 15 years. If this holds at scale, the entire economics of the carbon credit market start to look different.
The science is moving faster than the policy. That gap tends to close in one direction, and it's not the policy getting slower.
Someone in the capital markets is already doing the math on physical world bottlenecks because this week, the Great Rotation became impossible to ignore. The Russell 2000 has outperformed the S&P 500 for 14 consecutive trading days, the longest streak since 1996. 2 names getting unusual attention. Sterling Infrastructure, ticker STRL, with its semiconductor reshoring segment, projecting 25% growth and a record backlog. And Construction Partners, ticker ROAD, sitting on $3.09 billion in committed projects. These are pavement and piping companies. Not glamorous, not discussed on financial Twitter. And right now, the rotation is treating them like the new semiconductors, because without the physical infrastructure, the digital economy can't run.
You can't put a data center in a building that doesn't exist. The physical world keeps sending invoices.
That same rotation is playing out in regional banking. Five Star Bancorp, FSBC, and HBT Financial, HBT, are 2 small regionals logging double-digit gains this year as the yield curve normalizes and small business loan demand returns. These are branch office banks in the Central Valley and rural Illinois. They don't trend, they don't have analyst coverage in the major houses. But the yield curve is their friend right now, in a way it hasn't been in years, and the capital is noticing. Now let's leave markets and go where the energy shock is landing hardest, because it's not where the cameras are. South Africa woke up on April 1st to the sharpest single-month diesel price increase on record. Diesel up more than 7 rand per liter, petrol up over 3. According to reporting from EWN and IOL, the government moved to cut the fuel levy by 3 rand as emergency relief. But the structural problem doesn't change. South Africa imports nearly all of its refined fuel, is fully exposed to the Hormuz shock, and is now watching that cost ripple into agriculture, logistics, and food prices in real time. The finance minister can cut the levy. He can't cut the barrel price.
South Africa is a template for what this shock looks like in economies that import fuel and don't have the reserve capacity to absorb it quietly. It won't be the last country to announce emergency cushioning this month.
Egypt is the canary for what comes next. It faces $27 billion in external debt service due in 2026. Right now, at the same moment, hot money is leaving. Before the Iran crisis broke, Egypt had stabilized. Foreigners had parked over $30 billion in Egyptian debt. Then the conflict started, and according to reporting from Semaphore and the Atlantic Council, net outflows of over $1.1 billion hit the secondary debt market in a single week. Egypt's at the intersection of every pressure the energy crisis creates. It's a net energy importer. Israeli gas supplies have been suspended, Suez Canal revenue is disrupted, and the IMF program it was just completing is now under strain. If financing conditions tighten there, analysts point to Turkey and Pakistan as the next stops in the contagion chain.
Financial stress doesn't stay local, it travels, and it always moves faster than the press releases.
Further down the chain, and even further outside the news cycle, Myanmar is experiencing fuel queues long enough that people are fainting in the heat while waiting to fill up. This isn't appearing in Western media. It's the human signal, not the market signal, of the same pressure system. The Global South doesn't get the emergency cushioning press conference. It gets the queue. And one story that compounds the squeeze deserves a mention. The UK announced it will cut its aid to Africa by more than half over the next 3 years. This lands on top of U.S. aid cuts already in motion, and organizations on the ground are describing the combined effect as potentially unsurvivable for specific programs. No dramatic event, no single moment, just a slow withdrawal of the floor. Now here's the counterintuitive positive that barely made it out of California. In March 2026, the state announced a formal framework to return 7.5 million acres of land and coastal waters, roughly 7% of the state, to indigenous tribal stewardship. This fulfills a treaty promise made when California entered the Union in 1850 that Congress shelved without telling the tribes for years afterward. 175 years later, no mandatory timeline, but a formal policy mechanism that didn't exist before. Worth noting, the same tribes would revive traditional controlled burning practices that have been banned for decades, the same practices that, if used consistently over the last century, would have reduced the scale and cost of California's worst wildfires.
The policy that could have saved billions got shelved for 175 years. That kind of latency is worth sitting with for a second.
Shifting to the attention economy, and a story that's accelerating quietly. Consumer enthusiasm for AI-generated content has more than halved in the last 2 years, dropping from 60% in late 2023 to 26% today, according to a creator economy report released at South by Southwest. The share of people who view generative AI as a negative disruptor has nearly doubled over the same period. This is happening at the exact same moment that AI funding hits $300 billion in a single quarter. The market and the audience are moving in completely opposite directions. That gap has to close somewhere, and it's not obvious which side moves first. That same tension connects to new earnings data from the creator economy. The Influencer Marketing Factory's 2026 report shows 48.7% of creators earn under $10,000 a year. Only 5.7% earn over $100,000. A middle class is forming in the creator economy, people sustaining income without celebrity. But it's fragile, and AI-generated content is the thing most likely to compress that middle layer. The audience appears to know something the algorithm hasn't fully priced in yet.
The audience is usually right about authenticity before the platforms are. It just takes a while for the revenue to say so.
A new limited podcast series called Money Trauma quietly launched in early March and is finding real traction in that middle tier. Created by Miho Soon and her team, it approaches financial anxiety from a trauma-informed angle. Not, here's how to optimize your savings rate, but here's why your relationship with money makes no rational sense. It's resonating right now because it's landing in a week when financial stress is everywhere, and the advice to just invest consistently has never felt more disconnected from lived experience. And we close on the internet being the internet. X, formerly Twitter, briefly displayed a viral post as having been sent in 1992. The tweet was actually from December 2011. A Unix timestamp overflow caused the display to miscalculate the date by roughly 19 years. Grok, the AI assistant, helpfully explained the bug in both English and Japanese. The replies, as you'd expect, included significant numbers of people asking exactly when the timeline broke. The answer is a floating point rounding error, circa 2011. Though depending on your feelings about the current state of X, 19 years off might be closer to a feature than a bug.
It's the only platform where a timestamp bug generates more engagement than the actual content.
So, 3 threads that connect this week. First, the energy constraint is global and compressing simultaneously at the science layer and the economic layer, from quantum batteries racing to reimagined storage to South Africa and Egypt absorbing the macro version in real time. Second, capital is rotating toward the physical world. Infrastructure, regional banks, piping, pavement. The hyperscale digital economy keeps outsourcing its invoices to the physical one. And third, there's a trust ceiling forming in the AI attention economy. Audiences opting out of AI content at the exact moment AI funding is peaking. When capital and audience move in opposite directions, one of them has to correct. Watch which one blinks first. Now let's wake up ready. We've built the weather map for the coming week. And I want to start not with a data release, I want to start with a deadline, because this one is already in the air. Up first is the expiration of Trump's extended ultimatum to Iran: reopen the Strait of Hormuz or face consequences. He's already extended this once. He's threatened to strike power plants if the deadline passes without compliance. Analysts estimate the world is currently losing 4.5 to 5 million barrels of oil a day because of this crisis. If the strait stays shut another 2 weeks, that number could double. That's not a background story for the week. That's the pressure system. Everything else is operating inside.
Every data release this week gets read through that lens. If the strait doesn't reopen, the inflation numbers look worse, the growth numbers look worse, and the Fed's job gets harder. The deadline is tonight. By Monday morning, we'll know which version of the week we're in.
Which brings us to Wednesday and the FOMC's March meeting minutes. This is the Fed's internal debate, not the press conference, not the carefully worded statement, the actual room. With energy at crisis levels, consumer confidence broken, and job losses accelerating, those minutes will tell you whether the committee was holding the line on rates or quietly panicking. The language matters. Watch for how many times the word uncertainty appears, because when the Fed uses that word a lot, it means they don't know what to do either.
When the Fed gets quiet in public, that's when you read what they said in private.
Tuesday opens with durable goods orders and consumer credit data. Durables tell you whether businesses are still betting on the future, whether they're buying equipment, machinery, the stuff that says, I think there's demand on the other side of this. Consumer credit tells you whether households are borrowing to maintain a spending level they can no longer afford on income alone. If durables are soft and consumer credit is rising, that's people financing the appearance of normalcy. That's not a recovery, that's a delay.
There's a difference between borrowing to invest and borrowing to survive. The data will tell you which one this is.
Thursday brings the third and final GDP estimate for Q4 2025. The second estimate came in at 0.7% annualized growth, already revised down from the initial read of 1.4. This final revision will either confirm the deceleration or push it lower still. If GDP for Q4 was actually closer to flat, it changes the starting line for every 2026 forecast, built on the assumption of a healthy handoff from last year. And alongside all of that, we're getting the first real inflation print since the oil shock hit in late February. PCE and CPI readings that will reflect for the first time what a $140 barrel of crude actually looks like in consumer prices. Economists are forecasting headline PCE could jump to 3.5 to 4%. That's not an inflation problem, that's a stagflation signal. Prices up, growth down, Fed stuck.
The data doesn't lie, it just arrives slowly. This week it arrives all at once.
Now, separate from all of that economic noise, there's a capital market story that got filed quietly on April 1st and is going to get very loud very fast. SpaceX filed confidentially for its IPO. Target valuation, $1.75 trillion. Target raise, $75 billion. That would make it the largest IPO in history, more than double the previous record held by Saudi Aramco in 2019. And here's the twist. It's not filing as a rocket company. It's filing as a combined entity that includes Starlink, XAI, and X, the social network formerly known as Twitter. The S1 is expected in late April or May. The roadshow targets June on the NASDAQ, and they're planning to give retail investors 30% of the shares, triple the typical IPO allocation.
The IPO isn't the story. The valuation thesis is the story. This is the first time a company has tried to price satellite internet, artificial intelligence, and a social platform into a single number, and then take it public in the middle of a geopolitical energy crisis. That's either visionary or catastrophically mistimed. We'll find out which.
Earnings season also kicks off this week. Delta and Constellation Brands go first, then the major banks, JP Morgan, Wells Fargo, Citigroup midweek. Watch the banks, they see everything: loan demand, credit quality, deposit behavior, and business confidence. Bank earnings aren't just earnings, they're a dashboard for the whole economy. Following shortly after, TSMC projecting 38% year-over-year revenue growth, and Netflix targeting a 31.5% operating margin. Those two numbers, if they hold, are the AI supercycle's proof of concept in real earnings form.
And that is how you wake up ready. There's a geopolitical deadline, a Fed transcript, an inflation print that's going to be uncomfortable, a GDP revision that could revise the whole year, the biggest IPO filing in history sitting in an SEC inbox, and a bank earnings week that'll tell you whether the credit system is still functioning or quietly tightening. That's the weather. It's a lot of weather.
Pick your watch item. Mine is the Hormuz deadline, because everything else this week is a forecast. That one's a binary.
I'll be flipping a coin then. Let's talk about dollar cost averaging. Not the famous version you've heard, the invest every month and don't try to time the market version. That's correct, but it's surface level. The real insight is deeper. Time for the knowledge bomb. Here's the mechanism. You've got $10,000. You could throw it all into the market today, or you could invest $1,000 a month for 10 months. If the market goes down, your monthly investments buy more shares at lower prices. If it goes up, your early investments appreciate faster. Mathematically, you're hedging your entry price against future volatility. But here's what nobody talks about. You're not actually reducing risk. You're transforming it. If the market crashes hard on day one and then recovers, lump sum wins. If it crashes at month 8 and keeps falling, dollar cost averaging wins. What you're really doing is paying a specific price for certainty. The certainty of not looking back and wishing you'd timed it differently. That's the knowledge bomb. DCA isn't about better returns. It's about better sleep. It's about converting market regret into a manageable cost. Now flip it. In an inflationary environment, dollar cost averaging is actually a drag. Why? Because every dollar you don't invest today is worth less tomorrow. You're deliberately holding cash at a time when cash is getting eaten. So DCA made sense when inflation was predictable and rates were stable. It makes less sense in a bifurcated world where the dollar's strength is contested and your purchasing power is under siege. The real play in 2026, lump sum into real assets on your timeline. Dollar cost average into leverage and optionality across time. Invest your capital but spread your debt. That's the inversion. Because in a world where patience is a cost, not a virtue, you need a different framework. And that's the knowledge bomb.
I've been thinking about contentment, which, as far as I can tell, is now considered a low-growth asset class. Humor me. If you told someone in 1995, I'm pretty satisfied with what I have, they'd say, that's healthy. If you say that today, people look at you like you just announced you're holding cash in a negative real rate environment. Oh, so you've just stopped optimizing? Because somewhere along the way, we turned life into a dashboard. Steps, sleep score, net worth, followers, productivity hours, even your calm has metrics now. You're not allowed to be content. You have to be performatively content, ideally with a chart trending upward. I tried it the other day. I woke up, had coffee, sat there, and thought, this is enough. And within 6 minutes, my brain was like, cool, but what if this coffee could be monetized? We've basically financialized peace of mind. There's a whole shadow economy now. Apps that remind you to breathe, newsletters about doing less, podcasts about detaching, delivered on platforms designed to make sure you never actually do. It's the only market where the product and the problem are vertically integrated. Feeling overwhelmed? Here's more content. And the advice always sounds simple. Just be present, right? But present where? Because my phone thinks I should be in 3 group chats, 2 email threads, and 1 LinkedIn thought leadership spiral, simultaneously. I think we've confused contentment with complacency, which are not the same thing. Contentment is, I have enough. Complacency is, I'll ignore reality. But modern systems treat both like underperformance. In fact, I'd argue we've created a kind of emotional arbitrage. We borrow dissatisfaction from the future to justify effort in the present. I'll be happy when becomes the most widely used forward contract in human history. And the returns are terrible because the goalpost moves. Always. You get the thing, and immediately your brain upgrades the benchmark. Oh, you're happy now? Great. Let's price in expectations for Q4. If this keeps going, we're going to have full-blown derivatives on fulfillment. I'm long gratitude, short comparison, hedged with occasional digital detoxes. Meanwhile, the underlying asset, just sitting quietly with your life, is illiquid and rarely traded. I even think there's a taxonomy emerging. Level 1 is aspirational discontent. You're grinding, chasing, optimizing. Level 2 is curated contentment. You've got the morning routine, the journaling, the cold plunge, all very shareable. And then there's level 3, which is just quiet. No audience, no update, no narrative. Which, ironically, is the least scalable and probably the most valuable. But it doesn't trend. You can't A/B test it. There's no growth loop for I'm good. And that might be the tell. Because the systems we've built, markets, media, tech, they're all designed around motion. More clicks, more trades, more upgrades. Contentment, by definition, is a kind of stillness. And stillness doesn't compound, at least not in a way that shows up on a quarterly report. So we keep moving, not always because we need to, but because the system rewards the appearance of motion. And every once in a while, you run into someone who's just done optimizing. Not checked out, not disengaged, just finished chasing. And it feels almost suspicious, like you're looking at someone holding an asset the market hasn't priced correctly yet, which might be the real punchline here. In a world that's constantly bidding up the next thing, contentment might be the only position where doing nothing is actually alpha.
There are debates that stop your reel, and there are the debates that linger long after the dinner plates are cleared. It's time for the greater debate. Let me set the scene. Two people. Both have been famous for decades. Both have had their names turned into cultural shorthand, the kind of shorthand where you don't need context, just the name, and everyone in the room already knows the shape of the argument. One of them became famous for turning down most of what fame offers. The other became famous for taking all of it and asking for more. We're calling this one the simple life versus the spectacular one. No moderator, two lecterns, and a question that sounds like a personality quiz but isn't. Is the good life built on less or more? This is the debate that runs underneath every financial conversation we have. It's underneath every how much is enough and every what am I actually working toward. It's the one at the dinner table after the second glass of wine. It usually ends with someone calling an Uber and nobody finishing the argument. Tonight, we finish it. Representing the case for simplicity, presence, and the radical act of not wanting more than you have, Keanu Reeves, the man who reportedly rides the subway in New York, who gave a substantial portion of his Matrix earnings to the special effects and costume crew, who has said more than once that he doesn't need much. He's not performing austerity. He's not making a point for the cameras. He genuinely seems to have opted out. That's either enlightened or suspicious, depending on your priors. Representing the case for extravagance, accumulation, and the idea that having it all isn't the problem, hiding it is. Paris Hilton. Not the tabloid heiress of early aughts memory, but the businesswoman who built a fragrance empire worth over $2 billion, who pioneered the influencer economy before the platform for it even existed, who has been more honest in recent years about the pain underneath the brand than most people expected. She didn't just inherit a position, she leveraged it, expanded it, and rebuilt herself inside it. That's not nothing. They take the stage, the room gets quiet. Keanu goes first, and he says the thing that everyone quietly suspects but can't quite say out loud, that more is a treadmill, that you don't own possessions, they own you, that every incremental upgrade in lifestyle is purchased with an incremental increment of anxiety. The bigger the house, the more things inside it to break. The more things to break, the more time spent managing them. The more time spent managing them, the less time for the thing that was supposed to make you happy in the first place. He doesn't say this bitterly. He says it the way someone says something that has simply become obvious, calmly, like he's been sitting with it long enough that he stopped needing you to agree. Then he makes a second argument, and this one lands harder. He says presence is the only non-renewable resource. You can make more money. You can buy more things. You cannot buy back the afternoon you spent refreshing a price alert on a car you didn't need. You cannot expense an hour of actual stillness. He says this isn't about sacrifice. It's about arithmetic. Simplicity isn't giving something up. It's refusing to trade something irreplaceable for something that can be replaced. The room leans in. There's a kind of permission in what he's saying, and people feel it. Paris lets him finish. Then she asks one question before making her first argument, and the question is this: whose version of simple? Because she grew up watching people choose simplicity by necessity, not by design. She watched people celebrate not wanting much because wanting much and not getting it was too painful to keep living with. She's not romanticizing accumulation. She's refusing to romanticize scarcity. The two things are not the same, and she'd appreciate it if we stopped confusing them. Her first argument is uncomfortable and correct. The freedom to choose simplicity is itself a luxury. Keanu can ride the subway because no one is financially dependent on him to arrive in a town car. He can give away tens of millions because he has more tens of millions after. The aesthetic of not having requires having first. You can't philosophize your way out of wanting more until you've built something to philosophize from. Most people in the world don't get to decide they don't need a safety net. They need one. And building one requires accumulation. She says, don't make a virtue out of an option that not everyone has. She pauses there. The room shifts. Her second argument is more personal, and because of that, more dangerous. She says, extravagance is a form of generosity that goes unmeasured. The party she threw last year employed 100 people. The brand she built employs thousands. Every fragrance sold, every event produced, every piece of content pushed into the world, it moves capital, creates livelihoods, and signals to other people that ambition has a return. She says she never wanted to be small, not because small was beneath her, but because she believed the world gets bigger when people push the ceiling up rather than lower their expectations to fit a smaller ceiling. Now Keanu delivers his knockout, and he does it quietly, which makes it louder. He says, "There's a version of your argument, Paris, that's sincerely true, and there's a version that's a sophisticated justification for never being satisfied. The question isn't whether extravagance can be generous. The question is whether you could stop, whether the choice is real if it's never tested." He says he knows what he has. He says he knows what he doesn't need. He says the thing he's most proud of isn't what he earned, it's what he walked past. There's a long pause, a real one. Paris doesn't flinch. She acknowledges something she doesn't often say out loud, that yes, there was a period in her life when the extravagance wasn't a choice, when it was armor, when the brand was a way of not sitting still long enough to feel the things that were sitting underneath it. She knows the difference between accumulation as expression and accumulation as avoidance. She's lived in both, and she doesn't confuse them anymore. Then she turns it back, and her knockout is this: the quiet life is also a performance for someone. The man who owns one motorcycle and wakes up early and has exactly 3 close friends is telling a story about himself. Simplicity has its own aesthetics, its own products, its own status markers: the minimalist capsule wardrobe, the analog watch, the uncluttered desk that costs more than a cluttered one. She says the only honest answer to how much is enough is that nobody actually knows, and the person who acts like they've solved it has usually just stopped asking. Both stand there, neither looks defeated, neither should. Here is what they actually share, which neither says, but both know. The goal was never the thing. It was always the feeling underneath the thing. Keanu built that feeling by subtracting. Paris built it by adding. They arrived at the same question from completely different roads. What am I actually building this for? And found that the question is a lot easier to ask once you've already answered the financial version. Most people listening haven't answered the financial version yet. That's why this debate still matters. And that is the greater debate.
Let's invent again. This week's invention is Richard Whitcomb's Supercritical wing, and here's why it belongs in an episode about invisible constraints and the future being built. Whitcomb was an aeronautical engineer at NASA Langley in the 1960s. Commercial aviation was hitting a wall, planes were getting heavier, fuel costs were climbing. Engineers looked at engines, looked at weight, looked at the obvious constraints, and they were solving the wrong problem. Whitcomb saw something others didn't. He understood that the real constraint wasn't engine power. It was drag, invisible, unmeasured drag, the way air flowed over a wing. He started with pure physics and a basic question: what if you designed the wing to manage airflow differently? Not bigger, not stronger. Different. He came up with the supercritical wing: thick leading edge, flat top, bulging underside, downward lip on the tail. It looked wrong. It looked counterintuitive. But the math was right. The wing changed how air moved around it, reducing drag fundamentally. And when drag goes down, everything else becomes possible. Farther flights, heavier payloads, less fuel burned. The supercritical wing didn't make aviation more powerful. It made aviation more efficient. And that efficiency compounds across decades. Nearly every commercial aircraft flying today uses a variant of Whitcomb's design. Billions of dollars in fuel savings, all from understanding an invisible constraint that everyone else had overlooked. Here's the connection. This week we're seeing capital flood into visible constraints. Power plants, semiconductors, data center capacity. Those are real. But what Whitcomb teaches us is that the real breakthroughs often come from understanding the invisible constraint first. What's the drag in the AI infrastructure stack? What's the hidden friction that nobody's measuring? What if the answer isn't more watts, but smarter architecture? The unexpected consequence? When Whitcomb invented the supercritical wing, he made aviation possible for a whole different set of uses. Planes that couldn't have been built became viable. Routes that weren't economical became profitable. The constraint he solved wasn't just a ceiling, it was a gate. And once you open that gate, the world that comes through is different than anyone predicted. Same thing happens with power. The moment we solve the energy constraint in AI infrastructure, we unlock capabilities we can't even imagine yet, because we've been designing around the constraint. Once it's gone, the designs change entirely. That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc. This week showed us a world in motion, moving in 2 directions at once. Confidence breaking, but capital confident. Jobs disappearing, but founders raising at record speed. Treasury yields climbing, but venture capital not pausing. The question isn't whether this resolves, it's when and how hard.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you, to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, agentweekly.ai.
Until next time, stay curious
Stay kind.
and keep compounding.